everyone, welcome back to another crypto video. So today we're going to talk about the volatility in the crypto market. We're going to talk about why the market can swing 40% a day, 20%, 30%, 60% in a day. Why there's so much fluctuation, why it's so volatile. So the first obvious reason is the market cap is small. I mean, there's only right now about $300 billion in the crypto market. I mean, like company Apple basically has that on hand. Nintendo has that in their bank somewhere. So it's such a small market cap. So people who hold a lot of crypto can influence the market heavily. That's what the pumps and dumps are. So people pump up the price, they'll sell, and then they'll drop the price in order to accumulate more crypto. So the second reason is that the people who are invested in crypto, a lot of millennials, a lot of Gen X's, a lot of younger people are invested in the market. People who might not really understand how markets work. They don't really understand how stocks work or how trading works or how, the technicals and how to read graphs. They haven't done the research, which is always a big problem. These people who really just want to chase gains and they want to get that, 50%, they want to double their money. They're chasing the 10x investment, So a lot of these people who, when they see the market start dropping, they panic. They panic and they panic sell. They say, oh man, I guess investing crypto was a mistake, and then they'll drop out. Maybe they only invested $100, so they lost like $25. Not a big deal. I guess they feel safer than losing 50%, which is fair. People who didn't do the research and they panic sell. The third reason is something that's pretty despicable. It's honestly people who took out loans and people who bought crypto on credit. People who took out bank loans for they said they're for a business to buy more crypto, which is fraud. So they might be serving jail time if they can't pay that back. So when the market's down 60% and it's time to pay back, they simply don't have the capital. They have to liquidate everything they can, sell their crypto, and take their losses. A lot of people traded crypto and a lot of people bought crypto without thinking about taxes. They sold high and bought low as much as they could. Maybe they made some good crypto gains, but they didn't think about how many taxes they had to pay on that. So say invested 60-70% of their income, and all of a sudden when you report this to the tax man, you got to pay a ton in taxes. That's what happens. So they got to liquidate. Again, young people. And that's what a lot of the crypto market is, 16-year-olds who don't really know what they're getting into. They don't understand the technology. They haven't been investing, 20 years like a lot of these experienced holders have. Something else is, and I'm sure there are tons of other reasons why, but I think those are really the main big ones is people are scared. I see posts on Reddit, on the internet all the time that say people, they're like, oh man, I don't know what I'm going to do if Bitcoin drops to 5K. I'm all of a sudden going to be losing a lot of money, blah, 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 blah. They just invested because a friend told them to, or they invested because they saw it in the news. Not because they understand the tech at all, just because they, follow the hype train, which is unfortunately what is a lot of crypto. I mean, if you look at a whole bunch of other companies and projects, they're moving forward. Two of my favorite projects actually put out their monthly updates, their quarterly updates, and they're making great progress ahead of schedule, and the coin's down. So it just goes to show you that the price of the coin is not tied to the stage of technology or the team or any of the fundamentals of why a coin would be worth something. It's just because of hype, and that'll change eventually. People will start to understand the technology, the market will become more stable. The smart money will have the majority of the coins because they held during times of dips, and they bought more during the dip, and they didn't sell their coins. So a lot of people compare this to the dot-com burst. It's a little bit different. So during the dot-com bubble, the infrastructure wasn't there. We didn't have cell phones, we didn't have laptops that could connect to the internet, we didn't have all these servers running to power the internet, but we do. The infrastructure is there. It's all there. Essentially what we're waiting for now is we're waiting for, on a larger scale, pretty generally, is Ethereum to release Caspernet. That's an example. We're waiting for these coins to actually finish their development. The hardware is there. but they need to finish, building these projects, and the projects will continue to move along faster than, the web did at the very beginning stages. So it all goes back to, you need to understand, and there's a lot of young money. You're going to see a lot more, ups and downs, and if you get into the crypto market, you need to know you could lose, 60% of your investment one day. Will it go back up? Maybe, it might, but it will make you feel better if you understand what you're buying. Always. I say that in almost every video. Understand what you have. Don't invest more than you could lose. Be smart, right? Thanks, guys. I hope that cleared some things up. Interesting conversation we had there. Thanks for watching, guys. Bye.